So if you're part of my newsletter, you'll know that I keep an eye on the Bitcoin miners as one of the proxies that I follow for the crypto market. And that's really because as a UK investor, they have some very attractive value propositions in places that we can't really get elsewhere. Now, I don't follow them all. There are loads of tiny cap companies that I just don't really pay any attention to. But I thought I'd share some of the information that I've been sharing on my newsletter for those who don't have time to do their own research. Here on the screen, you can see the logos of all the companies that I follow, which broadly covers most of the top miners. Now, this is just going to be a high-level overview rather than a deep dive into any one company. So if you're looking for that, then this probably isn't the video for you. But I'll probably look to do some more of those in the future if this video is well received. But if you're part of my newsletter, you'll be aware of which miners I favour and why anyway. Now, before we go any further, I just want to say that this isn't an endorsement or recommendation to buy any of the companies that I mention. I'm sharing what I do. I'm just sharing the high-level data for these companies only. There is loads more data that you probably need to look at if you're going to invest in any of these companies, and do your own research rather than just blindly following information that I've presented here. And I will also just disclose that I do own some Bitcoin miners, which I'll talk about maybe towards the end. So just as a quick overview, what is the value proposition? Why do I keep an eye on these Bitcoin miners? Well, the first reason is that they're a leveraged play on the price of Bitcoin. Now, for those of you who think that Bitcoin is already volatile enough, then just be aware that Bitcoin miners are potentially even more volatile. So the miners receive their primary income denominated in Bitcoin. So when they mine Bitcoin, they actually receive the Bitcoin tokens themselves. And the supply of Bitcoin is fixed. So therefore, if the Bitcoin price goes up and miners maintain their revenue denomination in Bitcoin, their revenue goes up with no additional overheads. Obviously, that works vice versa as well. And the other thing that many Bitcoin miners do is they also hold on to Bitcoin on their balance sheet. So for example, Marathon Digital, which is one of the largest Bitcoin miners and the one that I've shown here on the screen, they hold over 17,000 Bitcoin at the time of recording, worth about 1.3 billion US dollars. So movements in Bitcoin price not only affects the value of the company's holdings, but also its top line revenue. And that's why we see these kind of sort of moves above and beyond what Bitcoin itself would do. So if we look at the chart on the screen here, you'll see that when Bitcoin's price last spiked, as it did in 2021, then we saw a massive boost in share price for a lot of the miners. And you'll see that over the 5-year period, Bitcoin's actually outperformed the miners. But if you look at those isolated periods when you see explosions in Bitcoin price, that's when the miners tend to outperform. So the second reason, and it's quite an important reason for me, is that I can hold the miners in a tax-advantaged account. And I can't do that with any underlying cryptocurrency. So that means that we can not only amplify the gains and the losses that we make, but we can also do it free of capital gains tax. And of course, this isn't a problem if you're an investor from a region where you can access these cryptocurrency products in tax-advantaged accounts. But here in the UK, we just can't do that yet. So what's the business model for a Bitcoin miner? Well, fortunately, it's a really simple business model. There are a few sort of differences and discrepancies between the different Bitcoin miners, but this is just generally how it works. So because the Bitcoin miner business model is quite simple, it lets me keep track of a lot more businesses than I would usually be able to do in a sector. So typically when I'm looking to invest in a company, I'll look first for a sector that I like, and then I'll look at a top 2 or 3 companies within that sector, build out my models for those 2 or 3 companies, and then look to invest in my favorite one of those companies. So with the Bitcoin miners, I can actually keep track of a lot more. So I keep track of probably 10, 12 companies at once. And that's because they release monthly updates, so I can keep up to date relatively regularly in what they're doing. There aren't many surprises in what they release because generally the business model is quite simple. Beyond that, it's just time that's spent reading transcripts of earnings calls, reading their monthly updates and any rogue news that comes out. So the Bitcoin mining business model is effectively an energy arbitrage play. So Bitcoin miners take in an energy input and they use specialized hardware to mine the Bitcoin. Now, these equipment costs are relatively fixed. There's a fixed upfront capital expenditure to acquire the hardware, and then there's some limited ongoing maintenance costs, but the main input cost is the energy cost. And so you'll see that for many of the miners, that's really what they're hunting. They're hunting cheap energy. Many of the miners actually have operations in Texas in the US, and the reason is because the Texas energy grid, you can get energy for actually really quite cheap prices compared to many other places. But the Texas energy grid does have a major flaw, and that's that it really, because it has cheap energy, it attracts a lot of energy intensive companies. And so that means that at times of the year like summer, the Texas grid comes under huge strain because you have all these energy intensive companies using up energy just generally in the background, but suddenly all the residents need to flick on the aircon, etc., which really boosts up the energy usage. So you get demand response credits, really, that come into some of these Bitcoin miners' games, where the Bitcoin miners will be given credits for future energy to shut down their operations in times of high use. And so some of the Bitcoin miners make really good use of that. Now, once the Bitcoin miners have done their mining, they've acquired the Bitcoin, they've basically got two options. They can sell it or hold on to it. Now, I do think that the market tends to compress the price in terms of market capitalization of the miners who tend to sell. And that's because the miners who sell don't tend to benefit from this price reflexivity. We've said that the Bitcoin miners' revenue is denominated in Bitcoin. Well, if they hold Bitcoin as well as some of their cash reserves, then if the price of Bitcoin goes up, then not only does their revenue go up, but their book value in terms of their cash holdings or cash equivalent holdings also goes up. Now, obviously, this also introduces a lot of risks in the business model. It's very cash intensive. And to be honest, in many years, it's just a black hole for shareholder money. Money goes in, it's basically lit on fire by these companies. The price of Bitcoin also fluctuates outside the control of these miners. So if the price of Bitcoin drops down, their revenue drops down. And vice versa, if the price of Bitcoin goes up, their revenue can go up. And because of that, especially because a lot of them hold Bitcoin on the balance sheet as well, there's a huge amount of volatility in the share prices of these companies. And it's not uncommon to see 5-10% in a given day. And that's just on a pretty quiet day for these companies. It can get really crazy if Bitcoin spikes or drops. Just one other thing to make you aware of before we go any further in this presentation, and that's that many of these companies, to raise cash, don't borrow, they dilute. So that means that they dilute you as the shareholder if you hold shares in those companies. So many of the companies, if you look at the number of shares outstanding, you'll see they've really exploded in the last few years, as it seems to have become the favoured way for these miners to raise money. And the final thing that I just flag up, and this especially applies to many of the smaller miners rather than the larger miners, is that quite a lot of them have branched out into data centers for AI. So because of that, it's getting increasingly difficult to compare the companies apples to apples, but you can have a pretty good stab for most of the companies. So who actually are the big players in the space? So what I've done here is I've plotted the market capitalization of all the companies that I track and follow. Now, as we'll see later on, market capitalization isn't necessarily the best way of doing this, but by this metric, the kind of three big names that we need to look at here are Marathon, CleanSpark, and Riot. Now, because this is such a fast-moving space, small doesn't necessarily mean that they can't become a big company. So, for example, CleanSpark, which is the second largest company by market capitalization in the space, they've exploded onto the scene over the last 12-18 months, going from one of the much smaller players to one of the largest in a relatively short amount of time. And when we get onto it later in this presentation as well, you'll see that some of the small miners do have very big growth plans as well. So this picture could change very quickly, depending on when you're watching this as well. I think it'd be quite an interesting presentation to come back to in maybe 12 months' time and see how it's changed. But I will just say it's correct at the time of recording, but just, be aware, this is a really fast-moving space. I would also say that all the data in this presentation is based on Q1 filings for all these companies. The only company that haven't released that data at the time of recording is Hive, which I would expect to come out anytime soon. Knowing my luck, it will come out between when I record this video and when I post it, but that's just so you're aware. This is all up-to-date information except for Hive. So what are the North Star metrics that I track? Well, there's actually loads of different metrics that I track, but I would say for me, these are the three most important ones that I look at. So first is the book value of the companies. So the mining business is a really unstable business because of that price fluctuation of the underlying asset, i.e. Bitcoin, that these miners are trying to produce. So I really want a company with a strong balance sheet. I want a company that has lots of cash on hand, but ideally also at the same time, I want good cash on hand, but I also want the market not necessarily to be paying much of a premium for that book value of the company. So I actually calculate as well two variations of the book value of a company. The first is the book value excluding the digital assets. And that's because really in times of distress, it will be when those digital asset prices are falling. So I want to know what the rest of the company's financials look like if I strip that out. And then there's the more traditional book value, which just basically includes all assets and all liabilities. The second thing that I look at is the growth for a business. So I want really good, strong growth plans. And ideally what I'm looking for is the capex of those growth plans to already be achievable with current cash or current infrastructure. And that's because if companies are having to dilute a lot more, then that's going to suppress the potential share price increases in the future if they need to suppress and dilute to achieve these growth plans. And finally, there's the Bitcoin on the balance sheet. Now, this isn't a make or break type piece of information for me, but it is worth looking at because it affects that kind of price reflexivity that we were talking about. So if the company holds a lot of Bitcoin on the balance sheet, if the price of Bitcoin goes up, then not only does their revenue go up because it's denominated in Bitcoin, but their sort of liquid holdings, as it were, their cash equivalents in the form of digital assets also go up. And so it's got this kind of double whammy effect where it can really sort of amplify the gains and the losses for these companies. I would also just say that, just hopping back to the growth for a second, most of the data that I'm looking for is for the end of 2024 data. So I'm not actually looking that much further ahead at the moment. And that's because broadly the next 6 to 12 months is the time that I'm looking to hold these miners. And so beyond that, because they do tend to just kind of light shareholder money on fire, I'm not tending to look any further than that. Now, just to help you assess the lay of the land, the primary revenue stream for these Bitcoin miners is obviously the Bitcoin that they produce. And so we looked at market capitalization earlier, and we saw that the big three were Marathon, CleanSpark, and Riot. It's a slightly different story when we actually look at the Bitcoin that they mine. So that's the kind of primary thing that we need to look at here in terms of how the companies are doing revenue-wise. And we can see here that the big three are actually Marathon, Core Scientific, and CleanSpark, with Riot, who's the third biggest by market cap, a significant sort of distance behind those top three, sort of leading the best of the rest pack. This month maybe wasn't the best month to share this data because we had what was known as the Bitcoin halving in April 2024. So the Bitcoin halving, as the name kind of suggests, halves the rewards of Bitcoin coming out. So theoretically halves the revenue of these miners. So you can see this is a really turbulent time for these miners. And so the dark red dots there was the April 2024 Bitcoin mined data, and the kind of lighter red dots was the previous month. And you'll see that every single company, bar one, so Iron, which has some new mining power come online, produced less Bitcoin in April 2024 than it did in March 2024. And I'll be keeping quite a keen eye on the May numbers as well, because we'll maybe see a bit more of a better lay of the land, see how these miners are doing post-Bitcoin halving. Now, obviously, the main shakeup here was Core Scientific. So as you can see, in March 2024, they were actually the biggest Bitcoin miner in terms of Bitcoin produced. They fell back to number 2 this month after Marathon hopped ahead of them. But the reason that Core Scientific can mine such a huge amount of Bitcoin, but that they aren't one of the largest companies, is because they've recently exited Chapter 11 bankruptcy. So Core Scientific actually have around $1 billion of debt on the balance sheet. And so whilst they have a huge mining operation, they have to sell pretty much all the Bitcoin that they mine because it goes to paying down that debt. So the next of those North Star metrics I talked about was growth. So I've plotted here, so we've got the current operating exahash, and we've got, with the green dots, their proposed end-of-year targets. So currently, as per the kind of Bitcoin mined chart, there are 3 that really lead the pack. So Marathon, CleanSpark, and Core Scientific. And you can see from the green dots that we might have a slightly different pack arrangement by the time we get to the end of 2024 if most of these companies can achieve their growth plans. So perhaps the biggest names to call out here is Marathon, obviously going for a huge 50 exahash, which would put them head and shoulders the biggest miner. But then in terms of percentage increases, you're really looking at Bitfarms, Iron, and Riot as the companies that have got the biggest percentage growth plans lined up. Now, I would just say don't go blindly into buying on potential future hash rate because each of them comes with their own risks. So, for example, Riot are concentrating their hash rate growth in one massive facility at their Corsicana facility. Bitfarms have a lot of expansion planned in Paraguay, for example, and Paraguay has a bit of a love-hate relationship with Bitcoin mining. So there's a bit of sort of political risk there as well. So really what I'm saying is just do look at the individual miners. Don't just go, oh, that one has the biggest growth plans, therefore I'm going to buy into that one. Look at whether they can achieve those growth plans. Have they delivered on plans previously? There's lots of kind of background reading that needs to be done around these metrics. And so going back to that final metric, so Bitcoin holdings, so we can see that there are a number of Bitcoin miners that hold a lot of Bitcoin, but there are quite a few as well who just sell all the Bitcoin that they produce. Now, I mentioned Core Scientific before, so they're third from the right, Core Z there. You'll see that they sell all their holdings purely because of their emerging from bankruptcy situation. Now, I personally like the miners that hold a bit of Bitcoin, and you can see here I've put a table at the bottom that shows the percentages of the market capitalization to their Bitcoin holdings. So you'll see that there are really a couple of companies there who have huge Bitcoin holdings in relation to their market capitalization, especially when we look at, say, Hut, Hive, and Bit Digital there in the green. Hut's heading on for almost 60% of its market capitalization tied up in its digital assets. So that potentially makes it a closer proxy in terms of if you're looking for a one-to-one proxy. But to be honest, if I was looking for that, I'd probably pick a product more like MicroStrategy, where really you're looking at 95% of their company valuation is based on their Bitcoin holdings. Now, I would just put a little caveat in this chart as well. So Bit Digital, which is the furthest right company on the chart, so BTBT, so their holdings, the values that I've placed in this chart is a Bitcoin equivalent value. So Bit Digital actually hold around 50% Bitcoin, 50% Ethereum as their digital asset holdings. The reason they do that is they mine the Bitcoin, they then sell half of it to buy Ethereum. They then stake that Ethereum, which gives them a yield from their digital asset holdings. The idea is they use that yield to maintain their operations. So the idea is they don't have to sell as many of their digital assets as some of their competitors might have to do. So here's maybe just a bit more information on the growth plans going towards the end of the year. Now, I would say of all the miners that I follow, Hut is the only one that doesn't have an end of 2024 target. So they do have targets going into 2025. But I'm really only looking towards the end of 2024 at the moment for my kind of analysis. And so those are the numbers that I've really looked at in detail. And you'll see I've just set there the little green dot just at its current hash rate, basically just to indicate that there's no growth plans indicated for the end of the year. Now, we can see from the chart and the tables at the bottom that there's really three standout companies in terms of the growth of their hash rate. So you've got Riot, Iron, and Bitfarms as the kind of three big boys in terms of percentage increases. And we can also see how the market is valuing the current operating hash rates of these companies. Now, I would also just say there's a discrepancy between hash rate, energized hash rate, and operating hash rate. So the way I quantify them all is the hash rate is the amount of potential Bitcoin miners that a company owns. So it may have a lot of Bitcoin miners sitting around, but they might not all be energized, i.e. plugged in, which is kind of the next stage of that analysis. So the energized miners are the ones that are plugged in and could potentially mine. So if a miner then has lower operational hash rate than the energized hash rate, it signals some kind of maintenance issues going on, or some kind of reason why they've had to shut them down. Maybe it's power credits or something similar. Now, I will also just add a little note about CleanSpark in particular. So they've recently exercised an option for an additional set of Bitcoin miners, which will be delivered by the end of this year. They announced that after a lot of their targets for 2024 came out. So their end of year target is 32 exahash. But the current set of miners that they've recently announced that they've acquired, which are due to be delivered all before the end of this year, they haven't updated any of their investor presentation or investor guidance to increase the amount of exahash they're targeting by the end of the year. But if they can get all that new exahash plugged in, then that would potentially take them up to 40 exahash rather than the 32 that they currently say they're targeting. So there could potentially be a little bit of a surprise to the upside there in CleanSpark if they can build out the infrastructure to support these extra miners, because I assume that's what's holding them back. So then just to look at the valuations in a bit more detail. So I've got two presented values for the book value, like I said earlier. So really that bottom row of the table includes the digital assets and the top row excludes the digital assets. And you'll see the chart in the front excludes the digital assets. The reason just being, I like to say, a healthy company in terms of lots of cash and low debt. I'm also really looking for the companies that have the low multiples. And the reason for that is because if a company has a low multiple of its market capitalization to book value, it suggests that the market isn't pricing in much value that they can add onto their holdings. And so you see that some of the companies, especially companies like Riot, which have huge cash holdings compared to their market capitalization of the company, because they're holding so much in cash, there's not really much they can do with that cash other than spend it on infrastructure to grow the business. And so that cash is currently just sitting there at Riot, not really doing that much. And so I think that contributes a lot towards this kind of premium that we see some companies having over the others. I would also say another thing that contributes to this kind of premium that we see in market capitalization to book value is the efficiency of the Bitcoin miners. So, for example, again, using Riot as a bit of an example, they've really only been operating at about 2/3 of their total exahash capacity recently. And so that indicates they're having a lot of problems with maintenance. Whereas if you look at someone like CleanSpark, they're pretty much always operating at 95% plus month on month, which suggests they have a very efficient, slick operation. I would just say as well, it's quite obvious from the color schemes, but TeraWulf don't look particularly attractive by this valuation. There's a huge premium there of their book value for the market capitalization of the company. And that could mean that if we see significant price increase for Bitcoin, that TeraWolf might not be able to capture as much of that upside as some of its competitors, just because it already has that excess in its valuation. So what are my conclusions? So if you're on my newsletter, you'll know that I have a couple of minor positions, the largest of which is Riot, and I also have a small position in Iron. Riot has really strong growth plans, which are all expected to be realized this year. They have a huge amount of cash on hand, so if we see a downturn in the price of Bitcoin, Riot should be able to weather that no problem. So that's purely kind of the defensive side of that play. They've also been able to acquire some really cheap electricity. So their facilities are predominantly based in Texas, and they take part in the power response schemes. So when the price of electricity skyrockets, they switch off, get power credits, and then use those later to effectively get really cheap electricity. Now, I'm expecting to see Riot's exahash rate really start to ramp up in the next few months, especially as they've just started opening what's known as their Corsicana facility, which is a massive facility, and they've completed the first building and started to energize Bitcoin miners in there. So I'm expecting to see some of that growth start to materialize in their numbers in the next few months. And the reason for my position in Iron as well is I've always been interested in Iron because they've generally had pretty solid growth plans. The only thing that's really held them back, in my opinion, is that they sell all their Bitcoins. They don't necessarily have that price reflexivity that a lot of the bigger miners have. But really only in the last week, they announced massive increases in their growth plans. So previously they were targeting 20 exahash by the end of the year. They're now targeting 30 exahash. So they're going to go from one of the smaller miners to one of the larger miners at the end of this year. And so I bought into them, and I've seen really good returns recently from that since they announced that. So we'll see if they can follow through on that. Now, if you want more of this kind of information, I go into a bit more depth. You can get some more of that on my newsletter, which you can sign up for at theriskoninvestor.com. So that tracks my journey to building a £1 million investment portfolio. You get some of my thoughts on the markets. You get interesting news stories that have captured my attention. It's not all sort of Bitcoin miners. It's wider digital asset space and wider economic information as well. So hopefully you'd find that really interesting if you found this video interesting. If you're invested in the miners, let me know. I'd love to maybe make some more videos going into specific information about specific companies. Do let me know if there's any particular company you want a bit more of a deep dive into, because I'd love to make a video about them. But until then, I'll see you in the next video. Thanks for watching.